In this video, we're covering restricted stock units, stock options, and employee stock purchase plans. Restricted stock units, or RSUs, are shares of company stock given to employees as compensation. Unlike other forms of equity, RSUs are straightforward. RSUs vest over time, or when specific company milestones are met. Once they vest, you own real shares of company stock. You don't need to purchase anything. They're yours automatically. A portion of those shares is typically withheld for taxes upon vesting. You then receive the remaining shares in your brokerage account. Now, RSUs have become increasingly popular, especially at larger companies and well-funded startups valued over $1 billion. This shift gained momentum after the mid-2000s accounting scandals, as companies sought simpler, more transparent equity compensation methods. Stock options give employees the right to buy company shares at a predetermined price, the strike price, for a set period. They're particularly common in private companies and startups, serving as a powerful incentive for employees to help the company grow. When it comes to stock options, there are two types. Incentive stock options, or ISOs, offer special tax advantages, whereas non-qualified stock options, or NSOs, have simpler but less favorable tax treatment. Most stock options follow a vesting schedule, typically a 4-year vesting period with a 1-year cliff, meaning that 25% vests after the first year, and then the remaining 75% vests monthly or quarterly over the next 3 years. An employee stock purchase plan, or ESPP, allows employees to purchase company stock at a discount, typically up to 15% off market price. These plans use payroll deductions to accumulate funds between the offering date and the purchase date. Here are some important ESPP features. The maximum annual contribution is $25,000. Contributions are post-tax. The offering periods typically are 6 to 12 months. Purchase periods are usually every 6 months. The look-back provision often applies a discount to lower prices. The look-back provision is particularly valuable. Let's give an example. At the start of the period, the stock is at $10, and at the end, it's at $15. With a 15% discount on the lower price, you pay $8.50 per share. The immediate value is $15 per share. RSUs have a two-part tax consideration. Upon vesting, the fair market value of vested shares is taxed as ordinary income. This then appears on your W-2. The company typically withholds shares for taxes upon this point. As an example, if 300 shares vest at $10 a share, that's $3,000 taxable income. Upon sale, any gain or loss from that vesting price is a capital gain or loss. Now, the holding period determines that tax rate. If it's 1 year or less, it's taxed at short-term capital gains, or ordinary income rates. Now, if you've held it for more than 1 year, it's taxed at long-term capital gains, or lower rates. Now, incentive stock options offer potential tax advantages but require careful planning. Upon exercise, there's no regular tax due. However, you may trigger the alternative minimum tax upon exercising ISOs. You also must pay a strike price to acquire the shares. And then upon sale, for a qualifying disposition, which is most tax advantage, you must hold 2+ years from grant and 1+ year from exercise. The entire gain is taxed at long-term capital gains rates. In a disqualifying disposition, you sell before the holding periods are met. The difference between the exercise price and the sale price is taxed as ordinary income. ESPP taxation depends on how long you hold the shares. Upon purchase, there is no immediate taxation when the shares are purchased. A disqualifying disposition is when they are sold within 2 years of the offering date or 1 year of purchase. The discount is taxed as compensation income on the W-2. Additional gains are taxed as capital gains. In a qualifying disposition, you hold 2+ years from the offering date and 1+ year from purchase. Portion of the profit is taxed as compensation income, and then the remaining profit is taxed as long-term capital gains. Understanding your equity compensation is crucial for making informed financial decisions. Each type has unique features and tax implications. Reach out to us at range.com to develop a strategy that aligns with your goals and circumstances. Thanks for watching.